Hey everyone, this is Randy with Income Stacker, and today we're going to talk about the paperwork and process for buying mortgage notes. So again, this is kind of a high-level 30,000-foot view of the process steps, and we're not going to talk about finding the note, doing the due diligence on the note at this point, but you'll get some idea of the different steps. So again, it's kind of a 5-step process. The number one is to decide on the note to buy. Again, we'll talk about that in a second, but that is going to be described in more detail in other videos. The due diligence, what to look for, how to vet the note, that type of thing. But once you've decided on the note, the second thing is you want to review and sign the note sale agreement. So typically there will be a note sale agreement, or sometimes it's called a loan sale agreement, or even a sale agreement, and you're going to study that and make sure it's correct, and we'll talk about that in a second. Third, you wire the funds. So that's completed. Once that's completed, you review and receive and review the collateral documents. Typically you'll get that a week or 2 weeks out after the funds are wired. And then finally you would set up servicing so you could collect the payments. You typically don't want to do servicing yourself, so you get a third-party servicing company to do that. So it's a little bit different than buying a house where you go to attorney or a title company, you open an escrow, you have the purchase and sale agreement, and then you close with all the parties involved. This is most of it's remote, and when you're wiring funds, you wire the funds with the note sale agreement really backing you, because you really don't get anything once you wire the funds. You'll get your collateral documents later, but you do have, at that point in time, you can start setting up servicing, but let's talk about that. So again, step one is just decide on the note to buy. Obviously, we're not going to discuss that today. You might want to review the newsletter number 3, where we discuss the 10 main factors to consider when buying notes. We focused on performing notes in that particular newsletter. Again, the link is right there. And there's going to be other videos where we talk about the vetting process of notes, which ones to buy, how to decide which ones to buy, how much to pay for the note. There's so many things, but again, we're looking at high level, step ones. We're going to assume you decided on the note to buy. What do you do then? You decided on this particular note. What's step 2? Well, step 2 is reviewing and signing the note sale agreement. Again, as I mentioned before, a lot of times the NSA is also known as the LSA or LPA or SA or MNPA or the APA. There's a lot of different nomenclature out there. Most people at this point in time use either the loan sale agreement or the sale agreement or the note sale agreement. So I wouldn't get too concerned about the naming, but just wanted to make you aware of that. It's very different from the purchase and sale agreement in the sense that it spells out the terms of buying a note and not buying a house, of course. And it has different contents in that agreement, and we're going to go over that in a second. So what does it contain? What does the note sale agreement contain? What informations? So I kind of broke it out into these buckets here. One, obviously the parties to the transaction, right? Who's the seller? Who's the buyer? The second thing is the price of the note, right? You got to know the price of the note, you agreed upon price. The closing and cutoff dates. Well, what are those? Closing date is typically when you're going to wire the funds, and that's the closing. And then cutoff date is when you're going to start receiving payments. Assuming it is a performing note, there is a date and time when you're going to start receiving payments. And, again, everything is agreed up front with the seller and you, the buyer, or vice versa. You could be a seller as well. And then the next thing is the collateral documents. When and how the collateral documents will be transferred. Most of the time, they're just FedEx to you. You receive them, and typically in the agreement it says, okay, you'll receive them within a week, or 2 weeks, or whatever it may be. And if not, then you have some kind of recourse, because you definitely need those documents. You can't, if something happens, can you foreclose without the note and the mortgage? No. So you need those documents. It also spells out the servicing requirements and also reps and warrants. So the seller, what we call representations and warrants, and the buyer's reps and warrants. So each party has certain things that they have to do, certain things that they're saying is in this agreement. There's all kinds of little nuances in there. And then, what are the governing laws, for this particular transaction? Usually it's the governing laws of the state of the seller. So let's say the seller is in California and they're selling me a note in South Carolina, then the governing laws would be in California. But again, everything's negotiable, but that's, kind of typical. Also, there's an exhibit or a page in there. It shows the asset location, it describes the asset itself. It explains, okay, this is the original balance on the loan. It was taken out at such and such a date, so you know that you're getting the right loan, the unpaid principal balance, the sales price, all that good stuff. A lot of times, too, they'll put, okay, that it's a first or second position, but a lot of times they won't either. So you're going to do your due diligence with your title search, and the title search is going to tell you, what lien position you're buying, and you definitely need to know that because for obvious reasons, the value of the note will go up and down accordingly pretty dramatically. And then wiring instructions. Usually they'll have some kind of wiring instructions, what to do and where to send it and all that good stuff. Okay, step 3, wiring funds. Again, most people understand this, pretty straightforward. Usually funding occurs within 1 to 3 days from the date of signing the sale agreement. Again, there's no hard and fast rules, and it depends on the size of the trade. It could be one note or it could be, hundreds of notes. So, it's going to be different for each case. Wiring is just your typical thing. You got the bank name and address, the account name, routing number, account number, the typical things on a wire that goes out. And then I think the most important thing is referencing the note that you're buying. Include the loan number. Typically, they'll give you that, the address, because a lot of these sellers have multiple notes, and you want to make sure that, that when they receive the funds are posted to the right note that you're buying. Okay, step 4. They're going to send out, again, they're going to FedEx or some type of, they're going to send it to you. Again, you got to have the hard copies. They're going to probably send you copies like a PDF of these documents, but that's not going to be good enough if you have to do what? If something happens, you have to foreclose or you have to take some action, you have to have the original note, the hard copy, the mortgage deed of trust. So they need to FedEx those documents out, and what they call it the collateral package. That's what you're going to hear a lot, collateral package. And usually that contains, a multitude of things. I would say these are the main things. The original note, and again, you want the original, where you can see the ink on there. Because in some states, if you don't have that, you can't even foreclose. Now, every state's a little different, and there are things like lost note affidavits, which I'm not going to get into, which is, let's say the person lost the note. Certain areas will allow that. You definitely need to talk to an attorney if you're going to be doing buying a note with that. Make sure that state's okay with that. But most of the time, you want to get the original note in your hand, and definitely keep it where? Well, safekeeping. You want to put it in, not your desk drawer. You're going to want to put it in a safe, right? I have safes that are fireproof, waterproof, that type of thing. So you also get the original deed of trust or mortgage. And again, sometimes this could be a copy. I would accept that, because these things are recorded, so that's fine. Whereas the note is not. The chain of assignments, same thing. You'll get the original chain of assignments. And again, a lot of times they're recorded. That's fine, and that's what you want. If they're not recorded, you obviously have to have the original, because you have to get it recorded, and you can't record a copy. So you have to definitely have the original if things, if certain things weren't signed yet or certain things weren't recorded yet. So, for example, let's say the note was sold from person A to person B, and then from person B to person C, and then from C to D, and now it's going from D to U. All those different assignments along the way, you have to have copies of those. You have to have them either recorded. If you don't have it recorded, you can't have a copy. You have to have the original so you can have it recorded. So again, you need those notarized assignments from your seller to your entity, and obviously for both the note and the assignments for the mortgage, and the original note endorsements or allonges. So what does that mean? So a note endorsement is, on the note they'll stamp, hey, we're transferring it from person A to person B. It's kind of like an assignment, but it's for a mortgage. It's for the note, right? You're signing it from person A to person B, B to C, and so on. Sometimes they'll do what's called a allonge, which is just a separate piece of paper where they'll staple it to the note, and that'll be part of the note. And it basically says, okay, this note was endorsed or signed over to this person. And we'll show you some examples in later videos, but I think you get the idea. So you definitely need to make sure you're getting all your collateral and feel good about it. Also, one thing I didn't mention in here, which I definitely should have, is title policy. Title policy is something you definitely want to have. Usually there's an original title policy. If it's an institutional note, I'll get the original title policy, and that'll be part of the loan package as well. So unfortunately, I missed it on this checklist, but definitely keep that in mind as well. Now, you might not get that on a seller finance note, but you'll definitely get that on an institutional note. Even on a seller finance note, usually you'll get it as well. Okay, step 5, set up servicing. So servicing is pretty straightforward, but you need to make sure you find a servicer that will service the kind of note you're buying, right? Certain notes, certain servicers won't do, but most servicers will do, all kinds of different types. Make sure you understand the cost of that servicer. So just in general, standard loan servicing for a performing note would cost you $20 to $40 a month if there's no escrow, and $35 to $50 a month with escrow. Again, depending on when you see this video, it could change. It's usually going to be up and not down. Recently, many of them increased their prices a little bit. So again, things fluctuate, but you get some idea. So it's unlike so if you have a rental property, you have a property management company, what does it cost? Well, roughly 10%. So if you're getting $2,000 a month in rent, it costs you $200 a month. Obviously, this is a lot less expensive, right? So that loan could be a payment of $100 a month, or it could be $10,000 a month. You're still only paying the $20 to $40 a month with no escrow, or $35 to $50 with escrow. It doesn't matter what the size is. It's unlike, like I said, a rental. If the rental's $3,000, you're going to pay $300 versus a $2,000 a month, you're going to pay $200. Again, depending on the property management company. Special loan servicing just means, hey, the thing's not performing. It'll go into specialty loan servicing. That's what they call it in most places. Every place has their own little verbiage. But again, that cost is going to be anywhere from $40 to $100, depending on what they're doing. BK stands for bankruptcy if it's in bankruptcy. FC stands for foreclosure. So it's going to be different costs depending on what's happening. If they do things for you, like let's say they do a workout or a loan modification, they might charge you a couple $100 for those types of things. So, servicing can get kind of expensive, for non-performing notes, but for performing, it's pretty inexpensive. And then they'll also send out what's called RESPA letters. RESPA is just some rules and regulations that we have to abide by, and laws, and a lot of times they just simply call them the hello and goodbye letters, which the servicers will send out for you. And they'll also send out what's called I call them the TILA letters, which are letters, again, that are required to be sent out if you change ownership. So let's say you sold me a note. It goes from, ABC Capital to DFG Capital. Then there has to be a TILA letter sent out that showing that, the owner of the note has been changed. And where the RESPA letters really are referring more to the servicing has changed. So again, I have another video up, to explain that in more detail, and I'll probably redo that video. The video is pretty old, but at the time of recording this one anyways. So we're always trying to update because, things change all the time, and that's why you have servicers to help you keep up with the rules and regulations. Finally here, what are the benefits of servicing? Super important, I think, to, service everything. Could you self-service? Definitely not with institutional notes. I mean, you could, but, again, there's certain licensing you have to have, certain rules you have to abide by. It's just not worth it. You want to be safe. You want to do it right. So the benefits are you can have access to your accounts online. You just go online and you can see who's paid, who hasn't, that type of thing. That's wonderful. The servicer applies payments for you. They apply the late fees. They charge the late fees. They compute the interest and principal. The servicer prepares year-end statements, so you can see, if you have 10 notes or 1,000 notes, you can see what happened over that year. They also process payments. Let's say the person sends in a check, or they do an ACH, or there's an online payment portal typically. The servicer also does escrow, right? If they have insurance and taxes that are going to be escrowed, and they manage that as well, which is really handy. And then finally, they do the tax reporting at the year end. So, when you own a house, you get a 1098 interest, right? So for the interest, so you can deduct it on your taxes, and they have to send that out by, I think it's January 31st. So they do that all for you. So it's well worth the small fee that you're being charged. And you definitely should set up servicing for each and every note. So with that being said, hopefully you enjoyed the video. Smash the like button so you guys could see more videos like this. And if you have any questions, just shoot me an email. And we'll see you on the next video.